When reporting a change of income to your Covered California account creates an ethical dilemma. Hello, I'm Kevin Knaus with InsureMeKevin.com. And when you enter Covered California, you agree to report any changes to your household, such as a change of income, and you must do that within 30 days. However, sometimes reporting that change so drastically changes the costs of your health insurance that many people just pause and say, do I really want to do this? And even though they've agreed to report the changes, the personal costs, the financial costs can be quite high. So it poses a struggle for them internally. So let's look at a particular example. Derek, who is a landscaper over in Marin County, and he entered Covered California, and based on the prior year's receipts and taxes, he estimated he was going to earn $21,500. Covered California said that he was eligible for a subsidy of $551.47, the same as the cost for his Kaiser Silver 94 plan. So Derek's premium beginning in January is $0. So Derek's going along, and business picks up. He picks up some side jobs, and he's a small business owner, so he doesn't know what all of the revenue, but it's looking like he's probably going to be doing $37,000 for the year. So he goes to the Covered California Shop and Compare tool, puts in $37,000. His subsidy drops to $423, and he sees that Kaiser Silver 94 goes away. He's in a Kaiser Silver 70, and his premium is $128.99. And that is wrong. And Derek knows that it is wrong because he's already used a whole bunch of subsidy from his lower income through Covered California. So in reality, when Derek increases his income from $21,500 to $37,000 annually, the subsidy is only $295, still at a Kaiser Silver 70, and Derek's premium goes up to $255.98. And so that's what this graph shows here. So with Derek's lower income of $21,500, he paid $0 for his health plan through June. He then increases his income, like he's been asked to do, to $37,000, and his health insurance premium goes up to $256 per month, and he loses that Silver 94 plan. But how did that happen? Well, when Derek went into Covered California, he estimated his income at $21,500. Covered California, using the formula, said, your annual subsidy at that income, age, and zip code is $6,617. Covered California takes that annual subsidy, chops it up into 12 equal increments, and then sends 1/12 of the subsidy to the health plan every month. When Derek increases his income, Covered California refigures out what the annual subsidy will be for him, and it dropped to $5,081. Okay, not too bad, but Derek had already used $3,308 subsidy January through June because of the lower income amount that he had in there. So you take the subsidy of $37,000, which is $5,081, minus what Derek had already received, that $3,308, and the remainder is $1,772. Divide that by 6, and Covered California can only distribute to Derek's chosen health insurance plan $295 every month. So that is why his health insurance really skyrocketed, because there was less subsidy to send to the carrier. Now, if Derek had gone in with an income of $37,000 at the beginning of the year, his rate would have been $128, and it would have been steady all the way through. But Derek didn't know what his income was going to be. He's a small business owner. And even if you do work for a company, wages, hourly wage, sometimes you don't know accurately what your income is going to be. You may pick up a part-time job, or you may lose a part-time job. Who knows what's going to happen? The second hit, and this makes it even worse for people with lower incomes in terms of what do I do, is Derek lost the Silver 94 plan. With the really low cost sharing, he's now in a Silver 70. So those primary care office visits of $5 are now $50. The specialist visit went from $8 to $90. The X-rays went from $8 to $95. So you can see all of the cost of the healthcare just jumped up on him, and he only had like a $16,000 increase in his overall income. And the medical deductible, he had zero medical deductible with the Silver 94, is now $5,400. So if he has to go into the hospital, he's got to pay $5,400 before the co-insurance kicks in, and the annual maximum out of pocket for the Silver 70 is now $9,100. Before, with the Silver 94, it was $1,150. So we cannot blame anyone for hesitating, grappling with the ethics of the situation of, do I report this really modest increase in wages, have my health insurance premiums shoot up, lose the good cost sharing, going from a Silver 94 to a Silver 70? No, anyone that is sane is going to wrestle with that. I don't have an answer for it, but the Affordable Care Act, the way it's structured, does pose this ethical dilemma for people during the middle of the year. Now, we do know that when Derek does his taxes, if he does not report his income, he's probably going to have to repay some of those excess subsidies. If his income is over 400% of the federal poverty level, he'll have to repay all of them. He will not have to repay the reduced cost sharing of the Silver 94 plan, but just having to repay the subsidies may hurt. And of course, there's just kind of the anxiety and wanting to do the right thing, but doing the right thing can be very expensive within covered California. So if you have any questions or comments, you may leave those down below, and I will do my best to answer them. Otherwise, for InsureMeKevin.com, I'm Kevin Knaus.